Well, I think if you look at that chart and bearing in mind that liquidity leads markets, the peak in that chart occurred early in 2024. So it was really having its effect both on markets and more particularly on the economy, around the time of the election. And it's true that incoming Treasury Secretary Scott Bessent has already labelled um, Jay Powell and Janet Yellen at Fed and Treasury respectively kind of cheats in trying to bolster the markets to get Biden re-elected, and that's a pretty cute spot by him, but it's evident in the data, and the way that we look at it is to say that if you look at the Fed and what the Fed is doing, or what the Fed is doing sort of sous la table in terms of hidden policy, this not QE, as we sort of flippantly call it, is basically saying that what they're doing is they're purportedly doing QT, quantitative tightening, but actually they're injecting liquidity. Now, how can they do that? How can we square that circle? Parts are falling much faster, and the liquidity creating parts are actually expanding. And specifically, things like the reverse repo facilities being wound down quite dramatically. You've got fluctuations which are occurring in the Treasury General Account, which is an account that the Treasury holds at the Fed. It's like a cash deposit account. They can run that down or build that up. And that's been a source of liquidity at different times. You've got the Bank Term Funding Program, which was a support program put in place during the Silicon Valley Bank turmoil. That's now run off, but it was adding liquidity through the year. And you've also got the operating losses that the Federal Reserve is suffering because it's paying out more interest to coupon holders than it is taking in, or it's paying out more on the, I shouldn't say the coupon holders, it's basically paying out more on the reverse repo facility that it's taking in, and that basically is a source of loss, but it's actually an injection of liquidity for markets. So all these factors add up, and you can see on slide 15 we calibrate that in what we call not QE. Now, that's one source of impetus that people haven't really figured with, and that's a way of directly injecting liquidity into money markets. But there's another way of actually assessing liquidity, which is really looking at the duration impact of Treasury issuance. Now, if you're issuing a long-dated coupon bond, let's say a 10-year bond, or there or thereabouts, a longer-dated tenor, in other words, that will absorb balance sheet capacity among financial institutions and will basically take liquidity out of the system. And that is clearly a negative. And the more funding at the long end there is, the more that you get that liquidity being, if you like, soaked up by this issuance sponge, this coupon issuance sponge. Now, what Janet Yellen very cleverly did is change the parameters of how the US Treasury issues debt. She skewed a lot of issuance into Treasury bills, which are non-coupon paying securities with up to 1 year of maturity. And the reason they're very attractive is that the banks tend to hoover those up, because with a very active fiscal spending program going on, banks are getting a lot of bank deposits built up, and they need an asset on the other side of their balance sheet that duration matches those deposits. And what better than a short-dated Treasury bill? So the banks are very keen buyers of that stuff. And the other thing that Janet did was she also skewed the calendar of coupon issuance very much towards very short-dated coupons, 2, 3, 5-year coupons, away from longer end coupons like 10 or 20 or even 30-year. So she took about 1.25 years at least out of the average maturity of the calendar of issuance by the Treasury since the end of 22. So these things are really important. And the slide 16 basically calibrates that effect. And if you look at it, you'll see that actually that sort of liquidity impulse measured in terms of dollar duration was equivalent to what we saw during the COVID time. So, this is additionally, one should say, on top of the fiscal spending stimulus you're seeing. This is purely by changing the dial or whatever on the maturity of Treasury funding. So it's very important. Now, you can also see, while I'm on this subject, the impact of that on yields. And if you take a look at slide 18, what that's showing is the difference between the stated or headline or actual, I suppose it's fairer to say, treasury yield of the 10-year tenor. So what US government bonds are actually yielding in the market, which is shown as the orange line, and a bootstrapped version of that data, which has come from the agency mortgage market. Now, the agency mortgage market is a risk-free securities, very much like treasuries. They're held by central banks, even by the Federal Reserve. They're taken as risk-free risk-free instruments, and they should align exactly with the treasury market once you made a little bit of an adjustment mathematically for duration differences and convexity differences, but that's getting into the weeds of bond speak. But generally, they should line up. And if you look at that graph, what you can see is that they haven't lined up during this period of so-called cheating by the Treasury, or this big skew towards the short end of the issuance curve. And what that shows is it's basically about 100 basis points of difference in spread. So the Treasury market, the actual bond yield in the US, has been artificially suppressed by about 100 basis points. Now, what does that really mean to market participants? What it means is that, number one, I mean, obviously yields are lower than they should be, but it means that the yield curve is artificially depressed and was actually forced or was magically inverted when it shouldn't really have been. So had you used the agency mortgage market to cue as a cue for your yield curve calculation, you'd have seen that actually the curve was more likely upward sloping, indicating a strong economy, rather than negatively sloped, indicating potential recession. And that clearly, upset calculations of a lot of economists who didn't quite see that point. The other thing which is important, and is particularly important in the light of recent data, is that it also means that the TIPS market, the Treasury Inflation Securities market, is biased by about 100 basis points. So in other words, break-even inflation rates in America, stated break-even, the long-term or underlying inflation that the Treasury market is discounting, is again distorted by 100 basis points. So it looks as if underlying inflation in America is about 2 percentage points over the next 10 years, 2% per annum. Actually, in reality, it's over 3%. So the Fed is already sort of distorting people's perceptions here. There's more inflation and there's a more robust economy than we've been led to believe.